to continue our technical analysis videos, where we read things from the internet like Investopedia.com. Today, my friends, yes, we're gonna continue with this series with what is a gap. Just join me and Shui and let's go ahead and find out. I know, dude, I know you're hungry, but let's go ahead and get started. Playing the Gap, written by Adam Hayes. In volatile markets, traders can benefit from large jumps in asset prices if they can be turned into opportunity. Gaps are areas on a chart where the price of a stock or another financial instrument moves sharply up or down with little or no trading in between. As a result, the assets chart shows a gap in the normal price pattern. The enterprising trader can interpret and exploit these gaps for profit. This article or this video, motherfucker, will help you understand how and why gaps occur and how you can use them to make profitable trades. If you have any questions, let us know in the comment section. By the way, don't forget to like, share, and subscribe. Ring the motherfucking bell so you get notified. I'm not a financial advisor, by the way. Key takeaways. Gaps are spaces on a chart that emerge when the price of the financial instrument significantly changes with little or no trading in between. Gaps occur unexpectedly as the perceived value of the investment changes due to the underlying fundamental or technical factors. Gaps are classified as a breakaway, exhaustion, common gap, and continuation, or in other cases called runaway gap. Here we go, my friends. Breakaway gaps occurred at the end of a price pattern and signal the beginning of a new trend. This is actually a beautiful example, my friends. You can see the trend line drawn from the downtrend and the higher lows, the little peaks for higher lows, to create a flag, breaking the flag and creating the upside. That's a beautiful example. Exhaustion. I don't know if I said that correctly. Shui, how do you say it correctly, my friend? I apologize, my friends. I know that you want me to keep it professional, but thank you. Occur near the end of a price pattern and signal a final attempt to hit new highs or lows. Here we go. Exhaustion. Number 1, we got the bear trend. Number 2, gap with extreme volume, strong rejection, and new low. You can see that this arrow has a gap over here as well, leaving some gaps behind. You can see the range from the highs and the lows. You can see it here. This bearish candle going down. You can see that the price that day opened actually very, very low, went a little bit further down and went up, trying to close the gap, and it did close the gap. So actually that's a good example as well. Moving to the common gaps, cannot be placed in a price pattern. They simply represent an area where the price has gapped. This is the common one. You can see that it did continue with the upside, but it took down the price with a bearish candle. So it went down with a bearish candle, closed the gap, and continued with the upside and the momentum. Then we got the continuation gaps, also known as a runaway gap, occur in the middle of a price pattern and signal a rush of buyers or sellers who share a common belief in the underlying stock's future direction. So we got the runaway gap over here, bullish rise with minimal pullbacks, gap with higher but no extreme volume. You can see here that yes, we went up, but not so crazy, huh? And then number 3, projected target, taking the gap as the halfway mark of the trend. You can see that it was even another gap left behind here, and it just went higher, boom, and to the downside. Anyways, guys, to continue over here. So to fill or not to fill. When someone says the gap has been filled, that means the price has moved back to the original pre-gap level. These fills are quite common and occur because of the following: irrational exuberance. The initial spike may have been overly optimistic or pessimistic, therefore inviting a correction. Number 2, technical resistance. When a price moves up or down sharply, it doesn't leave behind any support or resistance. Number 3, price pattern. Price patterns are used to classify gaps and can tell you if a gap will be filled or not. Exhaustion gaps are typically the most likely to be filled because they signal the end of a price trend, while continuation and breakaway gaps are significantly less likely to be filled since they are used to confirm the direction of the current trend. And as you heard over here, exhaustion, closing, right? Boom, boom. And then over here, breakout of a triangle was a good first target. Look at that. First target. There was so many gaps left behind, huh? Over here, you can see in the bear trend. How to play the gaps? That's the question that a lot of people have. And I hope that you understood this example. There are many ways to take advantage of these gaps, with a few strategies more popular than others. Some traders will buy when fundamental or technical factors favor a gap on the next trading day. For example, they'll buy a stock after hours when a positive earnings report is released, hoping for a gap up on the following trading day. Traders might also buy or sell into highly liquid or illiquid positions at the beginning of a price movement, hoping for a good fill and a continued trend. For example, they may buy a currency when it is gapping up very quickly on low liquidity and there is no significant resistance overhead. Some traders will fade gaps in the opposite direction once a high or low point has been determined. Often though, other forms of technical analysis, for example, if a stock gaps up on some speculative report, experienced traders may fade the gap by shorting the stock. Lastly, traders might buy when the price level reaches the prior support after the gap has been filled. Key things you will want to remember when trading gaps. Once the stock has started to fill the gap, it will rarely stop because there is often no immediate support or resistance. Exhaustion gaps and continuation gaps predict the price moving into different directions. Be sure you correctly classify the gap you are going to play. Retail investors are the ones who usually exhibit irrational exuberance. However, institutional investors may play along to help their portfolios, so be careful when using this indicator and wait for the price to start to break before taking a position. Be sure to watch the volume. High volume should be present in a breakaway gaps, while low volume should occur in exhaustion gaps. Gap trading example. To tie these ideas together, let's look at a basic gap trading system developed by the Forex market. This system uses gaps to predict retracement to a prior price. Here are the rules. The trade must always be in the overall direction of the price. The currency must gap significantly above or below a key resistance level on the 30-minute charts. Actually, I wanna do this with a real life example, guys. So let's see. So let's look at the 30 minutes real quick. You can see that Apple created a rejection from 146 to 142 with a gap left behind. You can see over here that it continued. So it pulled back down a little bit to pick up a little bit of liquidity and continue with pushing higher to 150s. In this area over here, Apple just went down, but very, very low from 146 to 141. A lot of people took advantage of this drop as a drop opportunity and enter buys as well because it will definitely be looking for a close of the gap. The currency must gap significantly above or below a key resistance level on the 30-minute chart. So in this particular case, we're looking at Apple, and in the 30-minute chart, you can see that you can definitely appreciate the gap over here in the 30 minutes. It broke a resistance level. You know, it did pull back down, right? And it broke a resistance level. And it continued with the momentum to the next resistance, which was the broken support. Let's continue with this article and let's look at an example of this system in action. So you can see that it left the gap behind, created a resistance level, pull back down to go to the previous broken resistance, which is where it left the gap, created a support, bullish engulfing. That bullish engulfing, it basically indicates that you gotta buy and take some profit in the previous high, which is gonna be the resistance level. If you do support and resistance, you will understand this part of the strategy. The large candlestick identified by the left arrow in the GBP USD is an example of a gap found in the Forex market. This does not look like a regular gap, but the lack of liquidity between the prices make it so. Notice how these levels act as strong levels of support and resistance. And the bottom line, my friends, those who study the underlying factors behind the gap and correctly identify its type can often trade with a high probability of success. However, there is always a chance chance the trade will go bad. You can avoid this first by watching real-time electronic communication network and volume. This will give you an idea of where different open trades stand. If you see high volume resistance preventing a gap from being filled, then double check the premise of your trade and consider not trading it if you are not completely certain it is correct. Second, be sure the rally is over. Irrational exuberance is not necessarily immediately corrected by the market. Sometimes stocks can rise for years at extremely high valuations and trade high on rumors without a correction. Be sure to wait for decline and negative volume before taking a position. Last, always be sure to use a stop loss when trading. It is best to place the stop loss point below the key support levels or at a set percentage such as -8%. And that is the article from Investopedia, motherfuckers. Thank you for stopping by and being part of this video. I hope that you have enjoyed it. If you didn't, we will do another video that will be much better, my friend. But anyways, guys, that's the video for today. I hope that you have enjoyed. Motherfuckers, don't forget to like, share, and subscribe. And as always, have a beautiful evening.
Monster kill.